Buying a home can be a stressful experience, especially in today's financially difficult times. But with the new $8,000 federal tax credit, first-time home buyers have a great incentive to buy. Trouble is, not everyone knows how it works. I certainly don't. Well, here's the chief tax economist from NAHB, the National Association of Home Builders, with the facts you need to know to take advantage of this great tax credit.
So who's eligible to claim the tax credit?
First-time home buyers are eligible for the tax credit, and the law defines a first-time home buyer as someone who has not owned a principal residence in the 3 years prior to the purchase that they would use to claim the tax credit.
What if I'm buying the house with someone else?
In the case of married taxpayers, both the wife and the husband have to be first-time home buyers. In other words, they have not owned a home in the prior 3 years. In the case of non-married joint buyers, only one of the joint purchasers has to be a first-time home buyer, and the IRS rules allow them to allocate the full credit amount to that qualified buyer, the person that hasn't owned a home previously.
How is this tax credit going to help home buyers and sellers?
The tax credit is going to stimulate demand, which will help stabilize prices. And one thing that's important to keep in mind is that even though it's limited to first-time home buyers represent about 40% of the home buying market. So it's a significant part of the home buying market that will benefit from the program.
What kinds of homes qualify for this refund?
Newly constructed homes qualify, existing homes qualify, just about any kind of home, whether it's single-family, townhouse, multifamily structures. The primary restriction is that the home has to be used as a principal residence. Investor buyers do not qualify.
How is the amount of the tax credit determined?
The credit is equal to 10% of the purchase price, up to $8,000.
Are there any income limits for claiming the tax credit?
The tax credit is subject to income limits, which means certain taxpayers won't qualify. Those income limits are $150,000 modified adjusted gross income for married taxpayers and $75,000 for single taxpayers. Just because you're above those income limits, though, does not mean that you don't qualify for the tax credit entirely. The tax credit phases out at $20,000 above those amounts. So, for example, a married taxpayer that has an adjusted gross income of $170,000 qualifies for a zero tax credit. And if you're in between $150,000 and $170,000, you qualify for a partial credit.
What is a partial credit?
So as an example of someone qualifying for a partial credit, in other words, a credit less than the full $8,000 cap, let's say you have married taxpayers who have a modified adjusted gross income of $160,000. That amount is halfway between the phase-out amount of $150,000 and the full phase-out amount of $170,000, in which the taxpayer would receive zero benefit. Because it's halfway, they qualify for a half credit of $4,000.
I read that the tax credit is refundable. What does that mean?
Tax credit's capped at $8,000, but it's refundable, which in tax terms means that even if you don't have $8,000 in tax liability, you'll still get that full amount as a refund from the IRS. This is particularly important for first-time home buyers because the average first-time home buyer only has about $5,000 in income tax liability in a given year. So in that case, if you have $5,000 in tax liability but you qualify for an $8,000 tax credit, you'll be getting a refund of at least $3,000 from the IRS.
How is the homebuyer tax credit different from the tax credit that Congress enacted in 2008?
The $8,000 tax credit is effective for purchases between January 1st in 2009 and December 1st, 2009. And unlike the $7,500 tax credit of 2008, which was effectively a no-interest loan, this is a true tax credit. The $8,000 can be kept. There is a recapture requirement, which is that you have to hold the home for at least 3 years, but that should not be a problem for most home buyers.
If I bought a home in 2008, do I qualify for this credit?
If you bought at the end of 2008, unfortunately, you're subject to the old tax credit rules, which means that you have to pay it back over 15 years.
If I'm qualified for the tax credit and buy a home in 2009, can I apply the tax credit against my 2008 tax return?
If you buy a home in 2009, you can claim the credit on your 2008 tax return, which significantly accelerates the moment in time in which you benefit from the refund. The way you do that, if you buy the home in early 2009, say before April 15th, you can claim it on your return when you file. If you claim it after you file your tax return, say in May or June, you file an amended tax return, and that can be done with a 1040X. The IRS usually processes amended tax returns within 8 to 10 weeks.
When can I claim the refund? What about buying existing versus building new?
The eligibility date is determined by the date of purchase, which for most home buyers is the date in which you actually close on the home, you receive the title to the home. The only exception to that is in a case in which you build your own home, assembling your own contractors. In that case, the date is the date of first occupancy.
Can I claim the tax credit if I purchase my home through a mortgage revenue bond program?
This is a significant improvement over the 2007 rules. Under the 2008 program, buyers who use a mortgage revenue bond program, which offers below market interest rates for first-time home buyers, they can claim the tax credit. 2008 buyers cannot.
Is there a way to get a refund in advance and use the cash as a down payment on the purchase of my home?
Typically, home buyers cannot use the tax credit as a down payment on the house. The reason for this is you can only claim the credit on Form 5405 after you've actually closed or finished the purchase. There are some things that home buyers can do, though, that accelerates the credit amount prior to when they purchase. One would be to reduce their income tax withholding because they anticipate claiming that credit on their tax return. And the second option would be to participate in a credit advancement loan program that some housing finance agencies may offer. A good example is a Missouri program, but you want to check with your state housing finance agency to see if they offer a credit advancement loan program.
I own a vacation home, but it isn't a principal residence. Can I still get the refund when I buy a home to use as a principal residence?
Actually, if you've owned a vacation home, you're not necessarily disqualified for the tax credit program. The first-time homebuyer definition is based on ownership of a principal residence in the prior 3 years. So if you owned a vacation home, but your primary residence was a rental apartment, for example, you would still qualify for the tax credit.
Now, if you haven't been to federalhousingtaxcredit.com, then go check it out. There are a lot more details about the tax credit there. I suggest the Frequently Asked Questions page. It's a great place to start. federalhousingtaxcredit.com. Go check it out.